Hi, I'm Nick Lacy, Chief Portfolio Strategist with Asset Management Services here at Raymond James. I'm here to address a couple of questions that I've been getting asked recently about the most recent elections here in the U.S. First, what are the implications on the markets for a Trump presidency and a Republican-controlled Congress? While it's difficult to say with any degree of certainty what the markets will do, what we can do is we can address what had happened the 24 hours after the elections and why potentially that might be more of the same going forward. If we look at which markets performed well and which markets did not perform well, I think we can get a good answer to that question of what is the market's expectations. For example, the markets that tended to do the best were here in the U.S., the small cap markets, specifically smaller companies whose earnings are maybe less reliant on global trade or outside U.S. Type of businesses. Markets that were the most impacted negatively were emerging markets. And emerging markets for the same reason. If we think about what a Trump candidacy leading into a Trump presidency means, we can look at some of the statements about policy that could potentially be enacted on global trade, potentially things such as immigration, stimulus spending, other areas. In addition to that, there have been a lot of discussions on decreased regulations or potentially the deceleration of an increase in regulations. If we think about sectors around the economy here in the U.S. that did well during the 24 hours after election, financials and healthcare were two sectors that did exceptionally well. We could come up to the conclusion that it was based on a lack of potential new regulation or potentially a decrease in regulation, allowing financial institutions and healthcare-based companies to see higher earnings in the future. Other markets that we saw impacted, bond markets saw some implications after the elections. We saw interest rates on bond yields around the world rise a little. In the U.S., the 10-year Treasury bond rates went up about 26 basis points, or about 1/4%. This could be due to the thought that, number one, we might see an increase or a slight increase in inflation in the near future as stimulus spending and less regulation could lead to higher levels of growth and higher levels of inflation. We also saw the exchange markets for currencies be impacted as the U.S. dollar strengthened against some of the major currencies around the world, such as the Japanese yen and the euro. On the other hand, we might see an increase in interest rates in December, and with a rise in the 10-year interest rate, this could lead the Federal Reserve a little more room to raise rates in December. What I would point back to is the fact that it's very difficult to point to something and say, here's what's going to happen. We can look at what has happened most recently and try to deduce what the market's interpretation of what should happen going forward.